When we express optimism about the equity markets, some might think we're being disingenuous and just saying that because it's our job. Well, that's simply not true. We do tend to be positive, just like the equity markets are positive most of the time. Approximately 70% of the time, in fact. However, our views aren't dictated by how stocks are performing. That's backward looking. But rather, our views are always dependent on the data. A lot of data. Our research folder is filled with hundreds of data markers and models that are constantly updated to help determine our views on where we're going. Investors often trade on emotion. Our role is to help investors rationalize and spot opportunities. So today, let's update the data. It's time for a mid-year economic health check. I'm Philip Petursson, Chief Investment Strategist at IG Wealth Management. Join me each week as we discuss the trends dominating the investment landscape. It's the week of June 10th, so listen on as we navigate the living market. Economic surprise indices have trended lower this year. In fact, macroeconomic data is mixed across the board. There are positive signs towards the global economy, as in rising export growth, but also signs of weakening, as with the recent increase in U.S. and Canadian unemployment. Now, this may be because consumers are split into two groups. We have the higher-end consumer that has benefited from a positive wealth effect. We also have the lower-end consumer that is still dealing with rising costs of rent and food, for example. Inflation explains this split. Lower earners spend a larger share of their income on the essentials, which after the past few years have left little for discretionary spending. The higher income consumer has also faced inflation, but not to the same extent. Provided the U.S. homeowner hasn't taken on a new mortgage, for example, their housing costs haven't changed, whereas those that rent have seen a significant increase. This combination makes inflation particularly challenging for those with the least financial flexibility. Consumers with investment portfolios as well have seen their net worth increase substantially since COVID, with the S&P 500 index gaining 60%, for example, from the pre-COVID high. Those without savings or investments have seen their spending power crushed, with the U.S. Consumer Price Index in the United States, for example, the gauge for inflation, up 20% since COVID. Inflation hits hardest on those with the least. This translates to the stock market as conflicting commentary from companies. Some are calling the U.S. consumer strong, and others are raising concerns. It also shows up in employment. In Canada, the unemployment rate is now 6.2%. This is above the pre-COVID levels and more than 1% higher than the lows of 2022. The U.S. is also seeing a similar trend with unemployment now at 4%, also above pre-COVID levels. While these rates are historically low, the trend isn't positive. We've seen inflation gradually move higher over the last 6 months. These two economies largely rely on consumption. As long as people have a job, they will continue to spend, which drives economic activity. However, rising unemployment and inflation can reduce disposable income, thereby weakening overall consumption and slowing economic growth. Despite these challenges, companies are still growing their earnings. Year-over-year earnings growth for the S&P 500, for example, is near 8% for the current quarter. Largely, this has been driven by margin improvements. The gains in profit margins have compensated for the slower sales growth. So who's making the money in such an environment? Well, the winners are the usual suspects: high-quality, large-cap companies. Smaller-cap companies are struggling to make any gains, with the spread between large and small caps widening out. Small-cap companies are more sensitive to interest rates, which explains the underperformance given the much higher interest rate environment that we've found ourselves in the last couple of years, versus large-cap companies that are less reliant on the credit markets and because they are cash-rich. However, before you think that small caps are in a great position going forward, since interest rates are likely to fall this year and next, remember that they're also very sensitive to the economic cycle. So they need a strong economy in order to thrive. That's a little less certain these days. So let's put this all together. We have a saying amongst the team: trust in the asset allocation. We want exposure to high-quality companies with growth prospects like U.S. technology companies, while also favoring defensive companies for times of economic uncertainty, such as interest-sensitive stocks. Where interest rates fall, these stocks tend to do better. This is a balanced approach to building a stock portfolio. If we're right and the economy continues to move ahead and growth is fine, then guess what? This portfolio should do well. If we do see some economic weakness, though, the more defensive aspects to some of the companies in the portfolio should provide a bit of a backstop to volatility within the equity markets. But we also want exposure to Canadian commodity companies, which tend to do well in late cycles. These sectors often benefit from increased infrastructure spending, and we're likely to see this ahead for factors that go beyond just the economic cycle that we're in today. And yet, we can't dismiss the valuation and earnings opportunities within the emerging markets. There are reasons to believe that emerging market indexes, including China, for example, have actually improved their growth prospects over the last number of months. And of course, we can't forget bonds, especially in a falling rate environment, as bonds tend to be our last line of defense in periods of market volatility. So as you can see, diversification is key. Data suggests that there are some weakening signs in the US or Canadian economies. It doesn't automatically mean that this will translate into market weakness, but making sure a portfolio is well positioned is key. So when it comes to looking ahead, we hate to use the words cautiously optimistic. Instead, today, we will say that we have deliberate apprehension with prudent confidence. I'm Philip Petursson, and you've been listening to Living Market Podcast. If you've enjoyed this podcast, please take a moment to rate it or share it with colleagues and friends. It'll help other like-minded individuals find us. Thanks for listening.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purpose, and IG Wealth Management is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from expressed herein. Our views are subject to change based on market conditions. Commissions, fees, and expenses may be associated with mutual fund investments. Read the prospectus before investing. Mutual funds are not guaranteed, values change frequently, and past performance may not be repeated.